If there was one word that can describe Indian equity markets in 2023, it would be resilience. In fact, this resilience helped markets achieve various milestones this year, despite the numerous challenges it faced due to a wobbly global economy. For the record, the S&P BSE Sensex scaled a new summit for the 11th straight year as it topped the 70,000 mark for the first time and marched ahead to hit a high of 71,913. With this, the BSE benchmark has recorded an annual net gain of 10,000 points. The Nifty, on the other hand, surpassed the 21,000 mark, hitting a lifetime high of 21,593 during the year. The rally, however, was not a one-way street. At the beginning of the year, the markets took a sharp knock in the aftermath of the Adani-Hindenburg saga. That apart, the collapse of US-based regional banks, rising interest rates, and geopolitical tensions added to the concerns. By the end of March, the Sensex was down 3% for the year and the Nifty 4.1%. The BSE Mid-Cap Index, meanwhile, was down almost 5% and the Small Cap 7%. Sectorally, the BSE Power Index plunged almost 25%, while the oil and gas and realty indices fell over 10% each. It was in April when the RBI-led Monetary Policy Committee paused its rate hike cycle for the first time since May 2022, triggering a sharp turnaround in the beaten-down equities. The pause in rate hikes raised hopes of a corporate re-leveraging cycle supported by the Union Budget's continuous infra push.
India's robust economic growth, has outperformed the projections. The government reforms like the Make in India initiatives, as well as the big push on the infrastructure sector during the budget, ended up being positive. The capex cycle has started, and the positive corporate earnings also played a very strong role.
Evidently, the Sensex and Nifty bounced back by surging 20.5% and 23% since April and have gained up to 18% year to date. The mid-cap and small-cap indices, meanwhile, have surged up to 54% since April and have jumped over 40% so far this year. Sectorally, the realty index has zoomed over 94%, followed by a near 73% and 58% rally in power and capital goods indices from March end. Another factor that helped the market recovery in 2023 was the strong comeback of foreign investors. Alongside the halt in rate hikes and an easing inflation trajectory, FPIs that remained net sellers for the previous year took to fresh buying this year with only a few months of withdrawing cash. That apart, a year-end rally in the US has further helped the market bulls in the latter half of 2023. This came as the US long-term bond yield that surged to a 16-year high of 5% is now on a downtrend, given the Federal Reserve's much-needed policy pivot earlier this month and a forecast of at least 3 rate cuts in 2024. This, analysts say, is further expected to keep the foreign inflows in Indian equities steady.
At the beginning of this year, it was widely expected that the US economy will tip into recession, but the year is going to end with 2.4% impressive growth by the US economy. In recent months, the decline in US bond yields also have helped in the rally in emerging markets like India.
Overall, 2023 was the testament of resilience and the growth potential of the Indian markets. Going ahead, analysts say investors remain cautiously optimistic on the markets in 2024 given election-related volatility in the near term.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
He's making plans for an early retirement. Business Standard.